All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. All right, guys, so today is April the 7th. It's approximately, what time is it? It's approximately 9:33 a.m. Eastern Standard Time. And of course, the market is closed, right? But nonetheless, I wanted to make a video to discuss what took place on April the 4th, right? April the 4th was a bloody day. Well, sort of, the market dropped rather drastically. In the afternoon as a result of the Federal Reserve Bank president of Minneapolis, Neil Kashkari, making a statement on April the 4th where he essentially implied that there will be no interest rate cuts, or potentially the interest rate cuts that were conveyed by Powell, I guess, during the FOMC meeting that took place in March, could potentially be off the table if the inflation continues to stall and the economy continues to be as robust as it has been. And so, as a result of those comments, or that comment, the market dropped drastically, and it's a perfect example. So what took place on Thursday, April the 4th, is a perfect example of the message that I always try to convey to my Flip That Option community, online options trading community, is that to really put the odds in your favor and to avoid these possible reverse in direction from the SPX like we saw on Thursday, April the 4th, is you want to actually trade in the direction in which the market is moving, right? And so what do I mean by that? So if we look at the chart, let me just pull up the chart. And by the way, so what took place on April the 4th was very similar to what took place on December the 20th, right? If you look at the charts, so here's a chart from December the 20th, 2023. And as you can see, everything was pretty much fine and dandy right up until around 1 o'clock, 1:15-ish, 1:30-ish. And then the market just fell off a cliff, right? Shit just hit the fan and the market just tumbled unexpectedly. Well, if we look at the chart from April the 4th, it's almost pretty much the exact same thing. Everything was fine and dandy right up until around 1 o'clock, 1:15-ish. And then this guy, this knucklehead, Neil Kashkari, comes out and make this foolish statement. Oh, by the way, Neil Kashkari isn't even a voting member for the Federal Reserve. So he doesn't have any say as to whether or not the interest rates get cut or not, but nonetheless, it spooked the market and the market tumbled. So as you can see here, the chart for April the 4th is very similar to the chart from December the 20th. And so each time, because my philosophy is you always trade. Let me pull out my pointer here. Give me a second, guys. Yeah, all right. Right, so my philosophy is you always want to trade in the direction in which the market is moving. So if the market is moving up, if the predominant direction of the market is to the upside, and particularly if it has already moved 20 points above the opening price, because if you have been following me, my philosophy is I don't look to put on a trade until the SPX, which is what I primarily trade, makes a 20-point move above or below the opening price, right? And so if the SPX is moving to the upside and it has moved beyond 20 points of the opening price, then essentially I'm looking to go on the call side, right? Because the call side essentially benefits from the price of the underlying going down. It's a bearish strategy. But the thing is, why would I do that if the market is actually going up and I'm looking to put on a position that's favorable to the downside? Well, because I'm just looking to get on the call side to the point where I have a high conviction that the SPX on its way to the upside will actually hit a point of resistance. That point of resistance will actually be below or right at my my short strike on the call side, right? So I'm just looking to get outside of the range of the SPX moving to the upside, so that way I'm able to avoid or mitigate the possibility of the SPX making an extreme reverse in direction, or some news coming out that was not forecasted on these various websites that I use to reference to see if there's any news on the horizon that could potentially cause the SPX to make a unexpected move. Oftentimes, these websites that I use just aren't, they don't cite that information because that information is just unknown. And so at any time, the SPX is running to the upside, for whatever reason, it can always, some news could come out and the SPX can drop drastically. There's a saying that, the market takes the escalator to the upside, but the elevator to the downside. So the market will fall a lot quicker than it rises. And so if it's rising to the upside, if it has made that 20-point move above the opening price, then I'm looking to trade in the direction in which the market is moving, right? And conversely, if the market is moving to the downside, if it has made that 20-point move below the opening price, then I'm looking to go on the put side, right? And so again, that's what allowed me on Thursday to avoid losing money on Thursday, because I was on the call side. Now I do have a position right now that expires on April the 10th. I'm on the put side, and the proximity of my position to the closing price of the SPX for this past Friday is a bit close, but I'm fine with that because the overall trend is to the upside. Now also too, one thing to keep in mind is that, so here's that big red candle that took place on Thursday, right? So now when we get these dips, when we get these short-term dips, when the overall sentiment is bullish, then that's a good time to get in, right? Because oftentimes what will happen is when you see these large moves and a 1% move for the SPX in one trading session is unusual. It's not odd, but it happens. It's a rarity. It happens. It doesn't happen very often. And so what you'll see the next day is you'll see a bounce, right? And we saw a bounce take place on Friday, right? And so that's a good time to actually, these large drops are a good time. These short-term drops are a good time to take advantage of getting on the put side and placing your credit spread on the put side, right? And so that's what I did, but and this is actually a roll position. So yeah, so this position is somewhat, rather close, and also the fact that on April the 10th we have the CPI number coming out. So I'm a little concerned about that, but nonetheless I can still roll, right? So, and also I have a position on for April the 18th that I put on April the 4th when the market actually tumbled, right? And so here is a position I have on for 50.90. I got $500 for this position, so now that I have two positions established on the put side, for this upcoming week, I'll be trading primarily on the call side, so I always encourage my Flip That Option members to, preferably you want to trade in a direction, although it seems kind of counterintuitive, because if the SPX is moving to the upside, then it would seem to make sense or common sense that you will go on the put side because the put side is a bullish strategy. And so if the market is moving up, then if you're bullish, then, you know, ideally you want to be on the put side for a credit spread. But again, you know, oftentimes, not oftentimes, but sometimes you'll get situations where, you know, you do what makes sense, but then you get days like April the 4th where some news comes out and the market just tumbles. And all of a sudden, you know, it's moving so fast that if you're not able to roll quickly or close out your position quickly, then you're going to lose money.